All right, welcome back. So we looked at the tax on the consumer, and we thought of that as a shift in the demand curve by the vertical amount of the tax. We did that in the last video. Now I want to move on and put a tax on the producer. So make this a little bit bigger. There we go. So we're going to put a tax on a producer. Let's look at the market for like Roundup, right, or chemical herbicides. And we have a graph here, price and quantity. Now, there's going to be some downward sloping demand curve, some upward sloping supply curve. That gives us an initial equilibrium. Right, and at the initial equilibrium, we have an equilibrium price and an equilibrium quantity. And at that market clearing equilibrium, we have economic surplus. Right, we have surplus to the consumers. These are consumers who would have paid these amounts on the demand curve. Right, the marginal benefit to them is reflected in the demand curve. They would have paid those higher amounts. They only have to pay the equilibrium price. So that difference represents consumer surplus. Right, if they were willing to pay this much and they only have to pay that much, they're made better off by that amount. And the same for all of these other quantities. So we have that triangle below the demand curve and above the equilibrium price that we call consumer surplus. Same for producers. Some of the producers would have sold for lower prices. That is reflected on the supply curve. Supply curve is based on the marginal opportunity cost of bringing units to market. If they would have sold for these low prices, but they get to actually sell at the equilibrium price, well, then they're made better off. Suppliers are made better off by the difference in between as well. And so this area above the supply curve up to the equilibrium price, that represents our producer surplus. So there you go. The market for chemical herbicides like Roundup in equilibrium, there's consumer surplus, there's producer surplus. But wait, what if we think that there are harms from using this that fall on other people, not the consumers and not the producers? What if there are general harms on the environment, if there are harms on neighbors or other people nearby? So let's say that the government says, well, we should try to encourage people to modify their behavior, make this more costly, maybe they'll use less of it. So let's impose a tax. Let's make it a $10 tax. Let's say that this equilibrium price is $40. Let's suppose that's the equilibrium price. We're going to impose a $10 tax on sellers, right, or producers, right, someone on that side of the transaction. So, legal incidence of the tax, that's the party who pays the tax up front, the party that you impose the tax on. That's easy, right? That's the sellers. We're going to put a tax on the producers or on the sellers. Well, what does that look like on the graph? You know, from the last unit, when we looked at factors that could shift the supply curve, you know that an increase in costs on the producer shows up as a leftward shift in the supply curve. And adding a tax on them is like another cost to producing, the chemical herbicide. So we could think of this as a leftward shift, an inward shift to the supply curve. Okay? So this is a leftward shift. Supply decreases, quantity supply decreases at every price. And the vertical distance here between the old supply curve and the new supply curve, that's going to be equal to our tax. So the tax equals $10. So what happens in our graph? Well, we have a new equilibrium, and it's up here, and the price that the consumers have to pay for the herbicide is higher, right? They used to pay the $40, now they pay something higher. Do they pay $10 more? Do the consumers pay all of the $10 tax? Well, no, right? Because we know that this distance right here is the tax. Right? This distance between the old supply curve and the new supply curve, that's $10. And if this whole distance is $10, then the distance from here up to the top has to be something less than $10. Right? But whatever amount the consumer pays, the producer has to pay $10 of that to the government in tax. So the amount of money that the producer gets to keep to cover all of their other costs of production, all of the other costs that they had before the tax, that's down here at P sub P, right? That's down here, the price that the producer gets to keep. And the amount of Roundup sold is now smaller than it was before. So you have a leftward shift there. The equilibrium quantity is smaller. Consumers pay a higher price. Producers get less. Where does that money go? Well, I think I like the light green, right? That's government tax revenue. The government collects this $10 tax right here on this unit, and this unit, and this unit, and this unit, over here on this unit, right? And every one in between. So for every one of these Q2 units, they collect this much tax, which means this rectangle right here, this whole rectangle, that represents tax revenue. Now, where does it come from? Well, some of it is carved out of what would have been consumer surplus, right? So some of it comes out of this section of consumer surplus right here, right? And then some of it is carved out of what would have been producer surplus. So whenever we think about the economic incidence of the tax, who bears the burden of the tax, who gives up surplus to pay the tax, well, that's actually consumers and producers. Because if you look at where the tax revenue comes from, it's carved partially out of consumer surplus and then partially out of producer surplus. So this box right here of tax revenue, this dark green is easier to read, isn't it? Not so much if you don't get it on top of the other color, right? Tax revenue. That's this rectangle right here. And it's carved out of both consumer surplus and producer surplus, so you could say the economic incidence of the tax is split, right? It's shared between the consumers and the producers. It doesn't have to be shared equally, right? But it will be shared. Now, is all of the surplus that's lost, is all of the consumer and producer surplus that's lost picked up by the government in the form of tax revenue? No. Right, there's this section out here, right? Some consumer surplus and some producer surplus, or well, what would have been consumer and producer surplus if there were no tax. But once you impose the tax, these units are, the value to the consumer, right, on the demand curve is greater than the cost to the producer, which you see here on the supply curve. But the difference is not $10. There's not enough space to wedge a $10 tax in there. So these units between Q2 and QE are not produced and sold. And so all of that potential revenue, all that potential consumer surplus, and all that potential producer surplus, that goes away, and we call that what? Deadweight loss. The deadweight loss of taxation, to be more specific, right? That's what makes the economist sad, because it's not just a transfer from one party to the other. It is, in fact, the vanishing, right, the going away, the lost possibility of creating that particular surplus. So there you have it. Now, what's interesting? Can you control the economic incidence, that is, who bears the burden of the tax, by who you put the tax on? Here we put the tax on the producers, right? And we saw that the producers bore, so the legal incidence was on the producers. The economic incidence was shared, partially between the producers, partially with the consumers. Now, compare that to our first graph that we did in the last video, where we put the tax on the consumers. Right? That shifted the demand curve, but what happened? In terms of economic incidence, it was shared. Both consumers and producers both lost some surplus to pay the tax. So the interesting thing here is that the end result is the same. The legal incidence has absolutely no effect on the economic incidence. Right? Here's your demand curve, here's your supply curve, there's your equilibrium, so your price in equilibrium, your quantity in equilibrium. Let's be thorough here. Here's the area of consumer surplus. What have I been using? Purple, I think, right? For producer surplus down here. And if we're going to impose a tax, if we're going to wedge a tax in here, should have used a different color. If we're going to wedge a tax in here, that's this big. Sometimes people call this the tax wedge, because you're really just, however big your tax is, you're just going to slide it from the left to the right towards equilibrium until it just bridges this distance, right, between the supply curve and the demand curve. And it doesn't matter. If we put the tax on the producer, we could think of this as a leftward shift in the supply curve, right? But if we, I took out more than I meant to. Let's undo that. See if I can do this again. There we go. But if we put the tax on the consumer, it would be a leftward shift in the supply curve such that the vertical distance is equal to the tax. Did I say supply? I meant demand. A shift in the demand curve such that the vertical distance is equal to the tax. But either way, whether it's a shift in the supply curve or a shift in the demand curve, you end up at exactly the same place. With this wedge in here, a tax revenue box, right, that looks like this. Shoot. And where was I? Oh, my picture went away. It had not saved. Well, that is a bummer. Either way, you end up with a tax revenue box that is the same, right? And that is carved partially out of consumer surplus and partially out of producer surplus. So again, let me just sketch it in on top of this one. It doesn't matter if you put, in a case of the last one we did, the chemical herbicides, it doesn't matter if you put the tax on the producers and it shifts the supply curve, or on the consumers and it shifts the demand curve by exactly $10, right? You end up with the same graph. So the legal incidence, that is whether you put this on the producers or on the consumers, right, and shift the demand curve, has no effect on the economic incidence. So to that then, the last thing that we're going to talk about in this tax unit is what does affect the economic incidence. That'll be a fairly short section, but that's what's coming up next. See if you can figure it out before we get there.